Hey, Paul, welcome to Financial Education for the Nation. And what would you like to talk about this week?
Hi, Warren. Hope you're well. I thought
good,
we could
thanks.
hit baby boomers this week and what's going on with them and their particular situation.
Cool. Okay. So baby boomers. Those who don't know, baby boomers are the largest cohort of our population. Born typically, the boundaries are very vague, but typically 1964 to 1946, that sort of era. So you're probably around about 55 up to your early 70s, that kind of thing. Born after post-Second World War. And these guys have had it easy, right? That's what everyone tells us. They've always had it easy. Work was easy for them. Housing was easy. Pensions was easy. Or at least that's what the Millennials and Gen Xers say. Okay, I'm sure they'll have a different argument to that. But we're going to go through it. I'm going to cover the 5 stages. So still the money plan, the 5-stage money plan, but it's tailored specifically for the baby boomers. So if you're a baby boomer, listen up. We're going to cover things like your vision, what's important, what you'll look forward to, what things you need to do, organization, what kind of planning you need to take into account, what foundations you need, how important is it to you to take into consideration the residential nil rate ban for inheritance tax, making sure you pass your estate down to those ones you love. What about the LPAs? We're going to cover debt. Did you know that the average pensioner has £34,000 worth of unsecured debt? Okay, so these are sensible people. That was a shocking statistic for me. And then finally, just understanding your pension, decumulation, taking money out your pension, and how does it all work? All right, so we'll get started with step 1, vision. So it was said to me years ago that you're only old when your memories outweigh your dreams. Okay, so come on, you're in your final chapter of your life. Okay, we talk about 3 chapters of your life: childhood, adulthood, and retirement. So if you don't know about that, in my new book, The Money Plan, talks about the 3 chapters of your life. And the final chapter typically is about 25% of your lifespan. Let's go out in style. Let's make sure we enjoy it. The past doesn't equal the future. Let's just make the most of what we got. If you don't have enough money saved for retirement, look, make changes. But let's start with number 1, a compelling vision. What does it look like? What do you want to do for the remaining years of your life? Now, that's a question itself. What is the remaining years of your life? At Lexington Wealth, my financial planning firm, we always plan to at least age 100 with clients. Now, average age of death might be, 88-ish, something like that. But you may not be average. So we need to make sure we plan at least to age 100. So have a compelling vision. And when you're doing that, set yourself some goals. Look at, what do you want to do? Let's have a look at what we want to do for the next year, the next 3 years, 5 years, 10 years. Where do we want to go? And for a lot of my clients, travel is a big thing. And one thing we'll talk about is distance of travel. So try and get all the long haul stuff in early on. So while you're still younger, fit and active, and I would say most baby boomers should be in that cohort, 55 to 70 odd years old, you're still fit and active. Let's get the long haul in now, do the distance, then we'll swap over to do maybe European holidaying or cruising, that kind of thing. And then in the last stages, then, we'll go and enjoy Cornwall, Devon, Somerset, and, enjoy the home country. But have some plan, have some structure, because if you don't have some kind of plan or structure, it's just going to go by. It's just going to go by. But squeeze the juice out of it. Let's make sure we enjoy our final chapter, our last, 25% of our life. Let's enjoy it.
Okay, sounds good. So I've got my vision and I think I know where I want to go. How do I get there?
Okay, so step 2, get organized. I am shocked, horrified, concerned, worried, reassured, I'm not sure, of the number of baby boomers who come in and see me who are not financially organized. And bear in mind, this is probably a lion's share of our clients. Okay, so most of the client meetings I've done over my 20 plus years as a financial planner, I've been with baby boomers. Okay, typically because they've got the money and they're the ones who need the advice. And, it's never too late to teach an old dog new tricks. You can do this, okay? Get yourself organized, make sure you know what's coming in and what's going out. But you need to go the next stage. You need to know, okay, what's going to come in when my partner, spouse, significant other dies? What pension benefits are going to continue? What expenses have I got on their death and then afterwards? So we need to have two sort of cash flows. We need to know, right, what's coming in now and what's going out now, and then what's going to come in and go out when we are on our own. So you might find that some of the pensions might finish. You might find that some of the pensions reduce. You might find that, okay, we've got funeral expenses to cover, so we need to make sure we've got provision for that. We might find that we've got slightly less on council tax, slightly less on food and that kind of thing. But maybe one of them was a driver and you're not a driver, so you now need to accommodate for transport. Let's go through your expenditure items. And remember, you can go to warrenshoot.com and log in, and there's an expenditure sheet on there that helps you with all the different items on there. Some of them won't be relevant for you specifically, but it will cover all the things that we generally cover with our clients. So know what's coming in, what's going out, not only now, but when you're on your own, because there's going to come a stage, if you're in a relationship now, there's just going to be one of you, and we need to plan now what it's like. And if you're on your own now, come on, step up, you can do it. All right, you can do it with my help, we can get organized, and we can get ourselves sorted. So what's coming in, what's coming out, what do we have? So what assets have we got? What's the value of our property? Do we own it? Is there a mortgage on it? What's the value of any savings we've got? Where is it? What's the value of our pensions? Are they in the best place they can be? Let's have a look at these things. And sometimes I'll come across any client really, but typically the baby boomers, and they'll have savings accounts and all over the place. They're trying to maximize their interest rates. Do yourself a favor, do your executors a favor, simplify your affairs. Honestly, simplify your affairs. You're not really gaining that much by getting an extra 1% here, 1% there, and all spreading the money all over the place. You're going to leave a bit of a complex scenario situation for your spouse, your wife, your husband when you're gone. So it's much better just have a nice, straightforward, simple affairs. Spend your time rather than focusing on the money, squeezing 1% here, there, and the other, enjoying the last 25% of your life. Squeeze the juice out of it. Make sure you spend time with the people you love, people you care about, and doing the things that you enjoy. Okay, so really important that you make sure you get your finances organized. Now, the bank account system is also the same. So making sure that you run your banking in a way that works for you. So if it's always worked for you and you've always been a good spender, then that's fine. I tend to find that this generation is pretty good with money. I think they've taken on good habits from their parents who, living during the war, didn't have lots of money coming through, so they were very careful where their money went. So taking those good habits on, unfortunately, those habits often got lost with the subsequent generations. But if you're good with money, that's fine. If you're not, you need some help, check out my articles on the bank account system. So that will tell you how we run banking. So money coming into the bills account. This is going to be a new one for a baby boom as well, trying to automate things. Some of you guys are great at it, but a lot of you still like cash, still like paying with cash, still like playing with checks and things. So it might be a change of habit, but work the bank account system to work for you. I'm not suggesting you have to change your whole lifestyle. Work it around so it works for you. And then we've got things like state pension. Okay, so if you haven't yet claimed your state pension, so state pension age now, and for ladies it's varied over the years from 60 to 65, but it's 65 now. So if you haven't claimed your state pension, we've got 6 months until you do claim it. You can request a state pension forecast. And you can do that by completing a form called a BR19 or going online to whichever one works for you. I will put a link to the pension forecast in the notes to the video, into the blog post, so you can get the link there. You can go online, log into the government gateway, you request a state pension forecast. Or if you prefer, which a lot of our clients do, just download a form called a state pension forecast, BR19. Fill that in, send it off to Newcastle. They'll send back in about 4 or 6 weeks a forecast of what you're likely to get at retirement. And they are extremely helpful people as well. So if you get any questions on that, just pick up the phone, run past any ideas with them. The state pension over the years has changed tremendously. You now have to, if you haven't retired, you now have to work for 35 years qualifying for national insurance to qualify for the full state pension. So it's a complex area, probably not for this show right now, but at least get yourself over and get yourself a state pension forecast. So, and what also shocked me was the debt. you know, the number of people who had debt in retirement. So whether you've got a mortgage, whether you've got credit card debts or loans and things like that, let's make sure you know what you've got, and let's try and get rid of it as soon as we can. Okay. Knowing what your estate taxes are as well, your inheritance tax liability. That's another thing. So adding up all your assets, okay, the value of your house, the value of any savings you got and things, adding them all up to anything you own yourself, add it all up, see what the value of that is. And then really anything, if you're a single person, it's £325,000. Plus at the moment, it's an additional £100,000 if you own a main home. So that's £425,000 per person. It's taxed at 0%. If you're married, you can double that. So that's 850, and that's taxed at 0%. Any excess over that is taxed at 40%. Now that additional £100,000, we'll make sure we put the detail in the blog post, is increasing each year. It goes up next year, so it goes up 125,000 in April, and so on and so forth. But that's only applied to your main home when it is left to a direct descendant, children, basically. Okay, so you can quite quickly add up your estate taxes and see whether you're liable for inheritance tax. But that's really about sort of getting organised, just making sure you're in the right place, you know what's going on, you know where your money is, what's coming in, what's going out, that kind of thing. Just make sure you feel good about yourself. Okay? Yeah. And then we move on to step 3. And then step 3 is the foundations. And the foundations are emergency cash, wills, power of attorneys, life insurance, disability, critical illness, medical and general insurance. So we're getting to an age in your life where you probably don't need, or you'll find that life insurance becomes expensive. So we need to make judgments on each of these things, whether they're appropriate. But let's start with the essentials. Emergency cash. You're going to, again, need at least 3 months of your expenditure in cash to make sure things go by nice and easily. The boiler goes, you can lay your hands on it. What I tend to find with baby boomers is they like cash. So 3 months is no problem. They'll probably want more. But look, guys, don't hold everything in cash because you're losing money against inflation. Interest rates are going to pick up. Inflation's picking up. Your cash is eroding in real terms, particularly against the things that you guys spend your money on. Utilities, holidays, that kind of thing. Okay. The inflation on those is greater than the inflation on tech. Tech tends to be a lot cheaper. Okay. So make sure you hold cash, make sure you feel comfortable and you sleep well at night, but you don't need to go overboard. 3 months to 12 months for an emergency fund of your expenditure is ample. Wills. Let's revisit your wills. Let's make sure they're all done. You're all happy with them. Make sure they've been witnessed correctly. And do me a favor, make sure they've been witnessed by nobody who's mentioned in the will, an independent witness. Makes it safe. Make sure your executors are going to be around when you eventually pass away, and start considering using trusts in the will. Maybe I'll do a separate video just on wills and the benefit of trusts. The real benefit for you of including a trust is the protection of the asset. It's not a Panama effect. It's not trying to save tax or anything else. It's protecting your money. So, for example, if you died, rather than leaving the house completely to your husband or wife, you could leave half of it into a trust. That just means if the person who's left, the husband or wife who's left, remarries or goes bankrupt, you never know, needs long-term care, your share of the house will always go down to your children because that's what your intention was for. Okay? Because it's in trust, it wasn't owned by the survivor, it'll go down to your children. As long as it's written properly, that's fine. It's really important you take advice and look into this. The second thing is if your children are not in stable relationships or your estate is quite big, you might want to consider leaving your estate, your residue of your estate when the second one passes away, into a trust rather than to your children directly. Because remember, once they get that money, it's in their estate. So if they were to die, they're taxed on inheritance tax. If they get divorced, it's a matrimonial asset. It could be shared with the ex-partner. All sorts of things. So if you want to protect your assets, consider trusts. Okay. So maybe we'll do a video on that and a blog post on that another time, just so we go into a lot more detail, because there's a lot to be said around trusts and things. And then third bit, power of attorneys. Everyone needs a power of attorney. I'm sorry, I think dementia is one of the biggest growing health risks to people of your generation. You may be soundmine now, but we never know what the future holds. Let's just make sure we get it in place. Failing that, anyone can fall and hit the head at any time. Okay, so health and welfare, social services, NHS, make sure that that's covered. So if you can't act on your behalf, gives your partner the right to go and talk to the doctors or social services and talk about care homes, that kind of thing, with confidence and security. They can't ignore you. Second one is property and affairs. Talks about your money, okay? So allows you to go to your bank and say, I need to draw that money out. Or speak to your pension provider. I need to draw some money out of this pension. They don't have to speak to you otherwise. If you don't have a power of attorney, it's a trip to the Court of Protection to get deputyship, and you're looking, I would estimate, between £5,000 and £10,000 at least, and a long amount of time. So get your LPA sorted out. Life cover, if you can get it, and if you've got debts, you need it. But if you don't, then I shouldn't worry too much about it. It's going to be more expensive in the latter years. Disability insurance, we can only insure income, so we can't cover that. Critical illness is going to become expensive once you go past 60, 65. So if you're a young baby boomer, you can consider it. It's a good insurance. But as you get in latter years, it's going to become very expensive. Medical insurance, very, very valuable if you can afford it. It's a great insurance. It's going to be high premiums, but it's a great policy if you can get it and if you can afford the premiums. If you've worked for the civil service, there is an insurer out there whose name slips me right now, but there is, if you Google it, I'm sure you'll find it, who offers special rates for people who've been employed in the civil service, who've been in the army, worked for the civil service. You get a special deal with those. So it might be worth looking at their terms and see what they're like. And general insurance, make sure when you're traveling, you've got suitable insurance, make sure your home's looked after. In general, you guys are pretty good at this. You make sure that things are insured properly, you tick the boxes, and make sure everything's okay. So your foundations are pretty much there. And I say that, for most of you, the most important thing is let's make sure we've got the wills in place, make sure we're happy with the terms, we've considered trust, and let's make sure we've got the LPAs in place as well. Does that seem about right? Okay.
All right. So foundation secured. So step 4.
Step 4, debt repayment. Now, this is the shocking stat. The average pensioner has £34,000 worth of debt. Now, that just blew me away when I saw that. £34,000. Now, if we relate that back to the average pension size, the average pension size is like £30,000 or so thousand pounds. So it's more than their pension fund. Where does this debt come from? From my experience, often it's helping out your children. That's really where it's often come from. You guys are good with money. Generally speaking, you're good with money. You've got big hearts and you want to help your children because they're saying it's tough. Come on, guys. You're only going to get one retirement. Right? You're only going to get a retirement. They're going to have their retirement when it comes. This is your time. Let's make sure we look after yourselves. So we need to get rid of this debt as quick as we can. I've done videos on the snowball effect. I've got articles on the website. Organize your debt and balance order. Let's make sure we're paying the least amount of interest as we can on it, and let's rapidly repay the smallest debt first. Make sure you're maintaining minimum payments, and then go on to the next, Let's get rid of this debt as quick as we can. If it's on credit cards, consider switching it to an interest-free credit card because you'll save yourself interest there, but let's just start overpaying and get rid of it as quick as we can. We want to be debt-free.
Okay.
And then we talk about investing. Now, in all the episodes previously, when we spoke about step 5 and we spoke about investing, it's all about accumulation. It's all about saving. It's all about taking the 7.5%, the snowball, and putting it into the investment and building up. But for a lot of you guys, you're going to be there now. You're going to be at the time where we're decumulating, we're divesting, we're bringing the money back and we're spending it. We've spent all these years saving it up. So really it's about a case of saying, well, where am I? Where is my money? Let's get organized. Let's go back to step 2 to make sure we know where our pensions are. And if you're in a final salary or defined benefit pension scheme, you're going to have a pension check hit your account every month religiously, like clockwork. You've got nothing else to worry about. Okay. But if you're of the many thousands who are in defined contribution or personal pension schemes, then we need to look at the asset allocation. We look at the money and look at your choices. Now, I think it was last week's episode was about options at retirement. What we do is whether we draw down or we take annuity. So you've got choices, and that was last week's article, so you can have a look at that. But really, one of the fundamental things is if you've got a portfolio of investments or cash, what we generally say to people is we want about 3 years in physical cash. Okay, 3 years of your income that you're going to pay out. Keep the 3 years there in cash as a constant. Then we have about 5 years in very low or quite low risk investments. So when we talk about low risk investments, we're talking about very short-term fixed interest or bonds. Then we take the balance of your money and we invest it in a portfolio that you're comfortable with, so higher risk. And the reason for doing that is we want to make sure we get growth on the money because, hey, you might be in your 60s or 70s now, but if you live till you're 100, that's 30 or 40 years. Okay, that's 30 or 40, that's a long time. So we need to make sure we get growth on this money so that it's still there when you are at that age. But that money is going to be volatile. It's going to go up and down. It's the stock market. Okay, so we need to have security. So we get our security from having 3 years of our income in cash.
When you say 3 years of income, what do you mean by that? How do I measure what 3 years of income is?
Okay, so let's say you got, I'm going to choose round figures here. Let's say you got a portfolio of £100,000. Okay, and let's say you're looking to draw £5,000 a year from this portfolio, so 5%. Okay, so we want £15,000 in cash, 3 years of the income.
Okay,
and then we need another 5 years, so £25,000 in low risk bonds. So I know I've got 8 years of my income, which is a long period of time, pretty much secure. It's not going to be fluctuating up and down the stock market. The volatility on it's going to be negligible. The downside risk is probably going to be up 2 or 3%. Okay, so I've got 8 years. So if you look back 8 years, you know, lots happened over that period. And then the balance of the money, so where do we get to? We said 5 years, 25, 34, it's 40,000, balance money, £60,000. It's going to be invested. And then what happens is a cascade approach. So we draw our year's income from our cash. Okay, we take a year from our bonds and replenish the cash. We take a year from our investments and replenish the bond. So we're cascading down.
Okay.
Yeah. And we do that because the equity side of things can grow. The fixed interest is going to give us a little bit of risk, but a better return than cash. In the 3 years, cash is going to give us certainty. And if the markets are down, if we're in a real doldrum, so the markets are going down, we don't have to take the money that year because we've got 3 years of cash, which allows a bit of time to recover. Then we've got a further 5 years of low risk investments. So we've potentially got 8 years of money we can draw on before we have to touch our equities. But what we generally like to do is cascade it down 1 year at a time. But if the markets are down, we would pause for a year, would allow it to roll over, and then would revisit the year after. But by doing it this way, we know we've got certainty and we're maximizing the growth as much as we can.
Okay.
In that portfolio, it might be in a portfolio of ISAs, it might be a general account. You guys might have investment bonds, which, you know, another vehicle that you can use to provide yourself with income. So wherever the money is held, what I'm really trying to say is, hey, look, just don't leave it all on cash. Leaving it all on cash with interest rates increasing, inflation increasing, is really eroding at the capital. And that's going to be one of your biggest risks, I would say, over the next 10, 15 years is inflation. Trying to make sure that you keep the real buying power of your money. So 3 years cash, 5 years medium term, low risk investments, and then the balance in an investment portfolio. Okay. Now, so that kind of covers things like, so we've touched on your final salary pension scheme, tick, we know that's being paid. We want to check in that we're going to get a spouse's pension, that kind of thing. We've covered the defined contribution or an ISA portfolio and how we're going to invest that. So 3 years, 5 years, and the balance of the money. But one of the biggest assets that you all have probably will be your home and the bricks and mortar that you live in. And if you were unfortunate enough not to have access to a final salary pension scheme, and if you've not necessarily been able to save up enough money to have an investment portfolio because you're doing other things, but you've still got your house paid for, that is an asset in its own right. Now, if there's equity in the house, in other words, if there's more money you own on it than you owe, and hopefully you don't owe anything on it when you get into retirement, you can do one or two things, but you can release the equity from it. My preference for you would be to start considering, where do you want to live in the final years of your life? And try and decide that earlier on rather at the last minute, because look where you live and look at logistics, look at the house setup, and think of yourself as an older person, maybe in your late 80s, Can you get around the house? Can you get out and about? Is there a community? Can you go to a shop and get your basic living needs? Is the house of the size that you can look after? If it's not, think earlier about moving than later, because we do get stuck in a routine. We do get fixed to our lifestyle and what we've got. And really, the later we leave it, the harder it's going to be for you. Okay. And by moving and downsizing, that is the cheapest, most effective way to releasing equity from your house. So if your asset, your main asset is your main home, my recommendation would be step one, seriously consider downsizing. Because by downsizing, it's going to cost you the least amount of money and it's going to be nice and clean and simple. You release a capital sum of money, you then go into the investment. 3 years cash, 5 years medium risk, balance into a more adventurous risk portfolio so it provides you with an income. Now, there are a number of reasons why people choose not to downsize. Attached to the house, they love it, memories, children, location, or it might be the ideal house for you. At that stage, if you don't have other assets, you can then start considering equity release. Equity release and lifetime mortgages, similar sort of thing. Basically, it's where you take a mortgage out against the property, but rather than paying your monthly payments to the lender every month, the monthly payments are added to the amount of money you borrow. So let's run an example. Let's say, for example, you own a £200,000 house and you borrow £100,000 against it. And the annual payments are, say, £5,000 a year, maybe let's say £6,000 a year, 6%. So it's £500 a month. So every month, rather than paying £100 for the £100,000 you've received, the £500 monthly payment gets added to the mortgage balance. So at the end of the year, you would owe the £100,000 plus the £6,000 of interest, which is added to the mortgage balance. That makes sense? So every year, your mortgage balance is increasing.
Okay, and what if I do that for another 18 years? Then suddenly I'm in negative equity.
Sure. So there is a negative equity guarantee on most providers. I'd probably just say every provider. I've never found one that isn't. They need to sign up to this association called SHIP, Safe Home Income Protection, I think it's called, which they give a negative equity guarantee. So you can claim on this ongoing. You have this, and the way you release it is you can either release a lump sum of money, so £100,000, or they can pay you it in installments. As you age in years, they will lend you more against the house, and sometimes you can go back to them and borrow more money against the property. So it's a great way of you realizing some of the value. Maybe you don't really realize all of it, but realizing some of the value of the property while staying in there. A couple of things you need to remember, though, is when you die, sorry guys, we're all going to die. When you die, your beneficiaries will only inherit the difference between the sale value of the house and the money you owe the mortgage provider. So that'll be what you borrowed plus all the payments that you should have paid. So you've got to bear this in mind. My belief, which is my belief, is you've loved your children, you've raised your children, you've looked after your children. Retirement is your time, buddy. Retirement is for you. Go and enjoy it. Don't intentionally deprive your assets from your next generation, but in the same breath, don't go out with regrets. I was having a conversation with a client just this week, and he was telling me about all the things he wants to do for his children, passing money down, helping with weddings, this, that, and the other. But he really regrets not having this one particular holiday. And I was like, what are you doing? How many more tomorrows have you got? I think he was in his early 70s. Okay, so it was a long haul flight. I think it was to Canada. It was in early 70s. I was like, book it. Book the holiday. Look forward to go. And do you know what? While you're there, when you get back, think, where would you like to holiday next year? And he came up with, I've got about 10 years of this good traveling in me. Let's book 10 holidays. Let's think, where do you want to go? Let's plan it out. Let's get a structure to this. So we've got Canada. Where else do you want to go? Let's put some thought into this. Load all the long haul flights at the top, so the early years. Europe, some fantastic places across France, Europe. A lot of our clients go and enjoy looking at all the war preservation areas in Europe, all the prisoner war camps, all the rural centres and the beaches, some fantastic stuff in France, and then drop in the latter years, they stick to the UK. But don't go out with any regrets. Squeeze the life out of this thing and make sure you enjoy it. It's what's important, because what's going to happen, you're going to sit there, you're going to die, then, I've seen this, your children are going to inherit the money. And one or two things generally happens. They inherit the money, and then they feel guilty that it's not theirs and they mustn't lose it, because mum and dad were very careful with it and they preserved it and they've given me this money. What the point is keeping money for? There's no point in it. There's no point in this. It has to be used for something. It has to bring benefit to somebody. Okay? So they got it, and then they're worried about spending it or using it, and particularly losing it. Okay? Then you've got the flip side. They've never had money. They don't know what to do with money. They've never been taught how to manage money. It goes through their fingers like water. They waste it on all sorts of things. You are better off gifting them money during your lifetime and enjoying your retirement along the way. You see the pleasure and the enjoyment in their face when you give it to them. So look at your cash flow. Look at your money. How much money have you got? If you've got a lot of money that you can afford to do this, try making gifts through your lifetime as opposed to saving up for your death. You get the enjoyment of seeing the smile on their face when they receive the gift. You get to see them enjoy what they've done with that money. You can even make judgments on, they made good decisions, I'd like to give them more money in future. Or actually, you're not mature enough yet to receive any more money because I didn't like what you did with that. But don't necessarily wait until you've passed away to gift your money away. If you can afford it, start gifting your money away during a lifetime. And perhaps actually, maybe we'll do an episode on inheritance tax planning as well. So we'll do one on wills, one on inheritance tax planning and the benefits of gifting during your lifetime and what the allowances are and things like that. But yeah, it's, we've only got one shot at this particular life. Okay, let's make it the most. If you're a baby boomer, I'm sorry to say you're in the last chapter, but let's make the most of it. The past doesn't equal the future, and it's up to you to go out with style. Think back when you were 18, 19 years old and things you used to get up to and all the dreams and ambitions you used to have. I'm sure there can be some excitement inside you, even if it's getting on a National Express coach and traveling around the UK, seeing places. Retirement and holidaying doesn't have to be expensive. It's what you make of it.
Okay, yeah. Great, thanks.
So, bit evangelical, bit passionate about it in the end, but I see so many people not living life to the full. It's important that we live life by design, not by default. Let's go and do it. But that was great. I enjoyed saying that. I hope you, as listeners, enjoyed listening to what I had to say. Please give me feedback. I do take on board your feedback. This was as a result of what one listener actually asked me to do. So I thank you so much for that. And connect to me because I know you're massive Facebook users, baby boomers. So connect to me on Facebook. I have a Facebook page, which you'll find at the bottom of the website, Twitter and Instagram and LinkedIn, all the other things. But thank you for listening, and I'll see you again in the future.